Okay, who here has joined us in the past? Raise your hands. Awesome. So you know at Relay, we strive for diversity. Do we have any English majors in the crowd? No? We're not that diverse, I guess, then. All right, anyone familiar with Charles Dickens? Excellent. Complete the sentence. It was the best of times? Okay, at least I didn't say it. And that's not completely true, unless, of course, it's the day after Stampede and you are a sanitation worker. Okay. Last year when we got together, we talked about funding delays and unpredictable demand forecasts while air travel, as many of you know, you flew here, has mostly restored itself to normal. But the venture community wrestled with a very quick banking crisis earlier this year. But we continue to struggle with what we consider to be a new normal, marked by high interest rates, a muted investment environment, and a dampened landscape. 2020 and 21 could best be compared to the Dutch strategy called total football. This is an aggressive, offensive playbook with constant fluid motion, very lot of scoring. And there was a belief that companies could achieve profitability in the public markets after raising funds every 6 to 9 months using what was called a growth at all costs strategy. And by the way, this offensive playbook, it functioned beautifully for many years. Companies, and we witnessed it, they were raising, they were growing, growing, and then exited at high valuations and high multiples. And that money got funneled back into funds like ours, and we invested into new names. That was, of course, until March 17th, 2022. That was when the Fed initiated their first of many interest rate hikes. Now, the few companies that reached IPO since then have mostly underperformed, and in some cases were significantly repriced before they even got to leave the change room. The 2021 tech cohort, they've experienced a decline of about 62% from their initial public offering. And what's more important is about 20%, a little more than 20% of the outstanding shares of these companies are still held by private investors. The issue is they've missed the opportunity to liquidate at the market peak and provide distributions, which in turn fund funds. You know the cycle, we saw it before. So because of this, late-stage investors are hesitant and apprehensive to push their companies to IPO and move closer to a loss. Arm, Instacart, Klaviyo, well, they were all expected to deliver a big boost to the slumbering IPO market in September. Since their launch, since their issuance, they've all declined substantially, and Instacart in particular demonstrated that a public offering is possible if investors are willing to accept a steep valuation cut prior to the IPO. I said it before, but not in these words. Liquidity is the fuel that drives investment. There does appear to be a unicorn horn that is stuck in the assembly line. Capital is tied up in the public and private markets because companies are no longer being valued based on vanity metrics. Rather, the fundamentals of revenue, margins, and EBITDA. And why shouldn't they be? The cohort, their brothers and sisters in the public markets, they're doing the same thing. Apple, for example, they no longer report on unit sales. Rather, they report on iCloud subscriptions, recurring revenue. Netflix, who used to solely report on subscriber growth, are now talking about improved margins based on their ad-supported tier. And Uber, who used to only talk about trips and rides, are now talking about a diversified revenue mix. It's now a defensive game. And when you change the game, you change the rules, you change the game. So question for everyone. Does anyone know the technical term for a team who is held to 0 goals in a game? Okay, really, there's no fans here. Nobody knows the technical term. Come on, no, shut it. No, this is European football. Okay, this is not American football. I'll give you a hint. It's what you put on your bed every Sunday. It's called a clean sheet. All of a sudden we have people who know what clean sheets are, huh? Okay. Does anyone know what team has the highest number of clean sheets in the English Premier League? What? Hearing's bad up here. The Man City. Who said that? Oh my goodness, Arif, good job, buddy. We got to look at that. You know what? I'll leave it here for you. I think the mustache is going to get in the way. Okay, Man City. Excellent. Look at that. They play the most defensive game in the English Premier League, and they've won the trophy the last 3 seasons. I believe they're also champions of the Championship League, but I cannot begin to explain that, so that's going to be for later. That'll be lunchtime. Okay, look, defense is winning championships, but there's a backlog of offensive-minded companies that are sitting and waiting to IPO. Let's also not forget that the majority of exits occur through M&A. And so what are happening in those markets? Well, I can tell you that higher interest rates are also complicating those markets. And let's start with private equity firms. There has been a notable decrease in the total number of deals, as well as the total value of dollars coming out, being used for acquisitions. The indication there is that there's far less debt leverage that has been being used in the past. There's also been a huge shift towards EBITDA generating businesses, which of course, as you know, reduces the overall universe of targets in venture. And valuations based on EBITDA multiples are significantly lower than they used to be when they were based on revenue. Private companies, who we used to also look for acquisitions and mergers, are also not buying startups. They're focusing on improvements to their core operations and their core businesses, and they're unwilling to take on additional cash burn, making the majority of venture-backed companies also very poor targets. We used to look at Microsoft, Apple, Meta, Alphabet, Amazon, all ideal acquirers, and who wouldn't? They represent $9 trillion of market capitalization and have $481 billion of cash on their balance sheet. Quick question. Do we have any economics majors in the crowd? Okay, beautiful. Maybe. I'm hoping you can get the answer to this. Can you name which country produces a similar gross domestic product? $481 billion? I'm willing to give hints. Okay. Pardon me? Did you say the UK? Oh boy, you're way out of the zone. Okay, hold on. Here we go. They famously mix mango, chicken, and cashews together. No? Still nobody? Huh? We got it. Thailand. Excellent. That's right. Their GDP is $479 billion. That's the same amount of cash that 5 companies have on their balance sheet. It's kind of crazy. So, even with the strength of their balance sheets, smaller, more strategic buys are still happening, but they're happening far less frequently. Companies are spending their money on research and development, and they're also focusing right now on how to deal with antitrust issues that have been arising from the EU for years, and more recently, the US. They're also using that cash for stock buybacks. Microsoft and Meta, they both recently announced a combined $100 billion of share buybacks. This is only slightly less than has been invested in venture this entire year. So, a high cost of capital, antitrust, a looming recession, and a focus on core business operations. I said this before, but liquidity is a fuel that funds investments. Now, this reckoning should naturally extend into the private markets, and it has. If we look at deal volume and deal count, the dollars coming in, it's down to pre-pandemic levels. And this slowdown is affecting all stages. Seed stage investments are about neutral. The size of those investments are about neutral to where they were last year, but the overall volume is down 40%. The impact on companies raising at Series A and B is even more drastic, though. There's 50% less capital flowing into that class. And if you look at Series C and later, those numbers or dollar values are down 30%. And let's not forget, that's down 33% from the year before. Once outliers, tech companies that are focused on profitability are the ones being funded because there is a predictable path to exit. Others continue to redevelop their playbooks, while the investment community, we just keep moving the goalposts. So where is the drop in funding? Who's causing it? Well, it's coming from three different places. The first are multi-billion-dollar funds, the second are crossover funds, and the third is corporate venture capital. All of these companies are investing, but they're investing in far fewer names and focusing on their existing portfolios. They're shoring up their balance sheets, they're focused mostly on later stage deals, and in many cases, they're right-sizing valuations. Last year when we spoke, we talked about deal volume, deal count, returning in 12 to 18 months. Well, if you look back at 2008, it took 2 quarters to hit rock bottom, and it took about 4 quarters to recover after that. The backdrop, though, if you all remember, was a banking crisis that led us to 0% interest rates. In 2001, it also seemed to take about 2 quarters to hit rock bottom, but the recovery was much lengthier for several reasons, but it also had the backdrop of 1.5%. So what should we do now? Is it time to panic?
All right, Marcus, what do you got for me?
Coach Lasso, how are you feeling about the team's efforts today?
I feel like everyone played their hearts out, especially Sam. Just gets better and better every game. He's really helping us fill that giant Roy Kent void.
And how many more matches do you think can end in a draw before you hit the panic button?
Well, Marcus, there's 2 buttons I never like to hit, all right, and that's panic and snooze.
Okay, so I'm awake and I am even-keeled. How about the rest of you? There is optimism that we are at the bottom. Interest rates, albeit high, have stabilized. There is more dry powder in the market than we have ever seen in venture, period. There's over $300 billion on the sidelines waiting to be deployed. And there are over 50,000 companies that have been venture-backed, many of whom are operating under a new playbook. The big thing, though, is investors are not meant to be observers. We're meant to be investors. I think in venture, the telling signal is going to be when the multi-billion-dollar funds deploy $50 to $100 million checks. We're starting to see a little bit of it now into new names. It's going to come a little bit more rapidly. They're sitting on a lot of cash. It has to be deployed. The next thing that will happen is the crossover funds are going to start to make their investments and signal that there is upside available and liquidity available in the public markets. And then things are going to start to move downstream, where we'll see a lot more velocity at the Cs, the As, the Bs, and we continue to see velocity at the seeds. Likely that is going to be another 9 to 12 months away. So the question is, where does that leave our companies in our existing portfolio? Well, like most companies in the tech space, they've had to deal with reducing headcounts, creating alternative sources of income, and reprioritizing to do more with less. And yes, we do have some companies in injury time, but in the short term, we think several of these assets, it'll be unavoidable that there'll be a capital restructuring, and with others, we will choose to liquidate, perhaps at values lower than what we anticipated at the market peak. These assets, however, are overshadowed by our top performers, who are extremely well capitalized. They've adjusted their burn to the new normal, and they have adapted to the new conditions. And then the question is, what about new investments? Any Maple Leaf fans in the crowd? Seriously, we have no Maple Leaf fans in the crowd. You can cheer, guys. Yeah, show yourself. Put your blue flag. Okay. All right. Well, the idea of a successful rebuild might be very foreign to you guys then. But rest assured that all great teams can rebuild, even through dynasties. And I'm here to say that I am surrounded by a great team, and we're building our portfolio based on a different playbook. Our focus areas remain unchanged. Fintech, prop tech, urban tech, sports tech. We are still investing at the earliest stage so we can invest alongside smart founders, take a front seat into their next round. Our player and team selection, that's a bit different. I want everybody to look to the person to your left, and now look to the person to your right, Okay, don't worry. This is not an exercise in what happened the first day of school where they told you somebody's not going to be there next year. I promise. Okay. But I do think that if you find yourself next to one of our new crop of entrepreneurs, you're going to be beside someone who launched a business in an era of profitability. These aren't businesses that are chasing endless capital or skyrocketing valuations. Rather, these are businesses that are focused on products that lead to revenue with high margin and ultimately to profitability. And so let's talk about how things have changed in our deal structure. Well, the deal structure today is different than 22, but our pace, it remains the same. We've prioritized priced rounds over safes and convertible notes. We're partnering with fewer, larger, more traditional funds who, like us, are in it for the long haul and can participate in multiple rounds of financing. And while many of the rounds are smaller, most companies have already launched their product and they're in revenue at the time that we invest. It's a different game, and we're playing by a different set of rules. Throughout the day, you'll be hearing from our entrepreneurs, some rookies and some veterans. They'll be sharing their playbook, and you'll get a chance to see firsthand why we think they have the winning ingredients. So grab your binoculars and focus on the talented players that we've got playing for Team Relay. And remember, if there is one thing Ted taught us, it's to believe. Thanks very much.